For the final project, you will also need to do a discounted cash flow analysis. You will compare your answer in the DCF with analysis to your comparable evaluations. Also, remember, the best analyses are a combination of both methods. Each serves as a check on the other. Are you getting numbers that are in the right ballpark? If so, you should be more confident of your analysis. If not, you might want to go back and question the answers that you've gotten. You have calculated DCFs many times, both in this class and in your first corporate finance class. To make things a little bit easier, we have given you the forecasting, so you don't have to go through all the ratios and projecting out all the numbers. Your task is to take these pro forma numbers that are given and turn them into free cash flows. Remember again from Corporate Finance 1 that to calculate free cash flows, you take revenues, subtract the costs, subtract depreciation. There's no interest in this expense in this calculation. Subtract taxes and then add back depreciation. Why do we add back depreciation? That's because depreciation is not a real dollar cash flow. You haven't actually used cash for depreciation each year. You spent the cash when you bought the equipment at the beginning of the project. You subtract depreciation in the income statement because it's an expense that impacts taxes. The more depreciation expense you have, the less your taxable income will be, and the less your taxes are. So as I said, add back depreciation. That altogether, revenues minus costs minus depreciation minus taxes plus depreciation added back is your cash flow from operations. Then subtract the change in capital expenditures. What additional capital expenditures do you need to make? And then subtract the change in net working capital. What is the year-to-year change? How much more working capital do you need because of this project or this acquiring this company? Once you've put in a set of free cash flows, you need to calculate terminal value. If you have 10 years of cash flows, what is the cash flow in year 11? Typically, you'll take the year 10 free cash flow, multiply it by 1 plus the growth rate, then divide that number by the WACC minus the growth rate. That will give you the terminal value in year $10. You need to bring that value back to year 0 along with all the intermediate cash flows, just as you have done in previous projects and cases. You will use the NPV function in Excel, which calculates the present value of a stream of cash flows beginning in year 1 to calculate the enterprise value, the value of the firm, that is, the value of debt plus equity. To get the equity price, you need to add excess cash and subtract debt. That gives you the equity value. Divide that now equity value by the number of shares outstanding to find the stock price. This is your base case valuation with the DCF method. We have calculated stock price with the DCF, discounted cash flow model, and other cases and homework assignments. Now let us continue. As you saw, there were 3 possible forecasts. They're in tables 4 and 5, which are on the same worksheet in the Excel. The company forecast, the management forecast, and a historic forecast. You are going to be assigned just one of these forecasts. Ignore the other 2. You're not going to get any extra credit if you calculate a DCF for all 3 forecasts. Just do the forecast that you are assigned. That is the only one that I am going to grade. Now, once you have done that, Your next step is to do a sensitivity analysis. This is very critical. This was emphasized in Corporate Finance 1. We talked about it some more in this class. And again, you need to figure out what variables your analysis is most sensitive to and show the sensitivity. Once you have a base case, it is very easy to duplicate that base case spreadsheet, change something in that base case, and get a new stock price. You will pick a few key points and show sensitivity. Well, the historical forecast numbers, maybe history is going to repeat itself, maybe not. That's a potential disadvantage of using history. Sometimes the growth rates aren't the same. Let's look at sales growth. What if sales are higher or lower? You can try different amounts of sales and calculate what the difference would be. Again, in this assignment, you're not required to do a regression or use analyst estimates, but you still can vary the growth rate in sales. You'll also want to show sensitivity to costs. You can have costs be higher or lower. SG&A, sales and general administrative expenses, can be higher or lower. Cost of goods sold can be higher or lower. Again, look at what the case says about cost control and how potentially after the acquisition, there can be more cost control, more efficiencies. You can also look at depreciation. That's going to be related to capital expenditures. Now, the case assumes that there will be higher capital expenditures, but maybe not. There's a potential advantage because Berkshire Hathaway has a lot of capital. Maybe it will be possible for Precision Castparts to expand because they will have an easier access to capital. You can vary the tax rate. In this case, the tax rate seems to be fairly stable, but what if taxes go down or up in the future? You don't have to vary the tax rate. Working capital, again, that could be lower or higher based on your numbers. GDP growth is going to be very important. We gave you a number, but you can change it. What if the terminal growth rate is a little higher or a little lower? That is certainly an excellent variable to look at. Weighted average cost of capital, that's another important variable to change. You had to make a lot of assumptions to come up with a weighted average cost of capital. What if that WACC is incorrect? Again, you can vary beta, and you can vary the market risk premium. You can vary the weights in the weighted average cost of capital and the cost of debt, or just change the WACC, assuming you've made those other changes. Again, what other economic forecast conditions going to be in the future? Are we expecting economic good times or a recession? Is this on another item to talk about? When we calculated equity value from enterprise value, we added in cash. But is this cash needed for operations? If the cash is needed for operations, do not add it back. But if the cash is really excess cash, add it back. State your assumption about the cash. Are there any non-operating items that you would need to consider in your cash flow analysis? Capital structure choice. What if Berkshire Hathaway changes its capital structure? Is it more appropriate to use a different capital structure for Precision Castparts? Multiples valuation. Again, what choice of comparables did you make? What choice of multiple ratios did you use? What companies did you use? What multiples did you decide were the most accurate? Look through the case for any qualitative concerns that might end up being a factor in your sensitivity analysis. We are expecting a very detailed and rich sensitivity analysis. You are getting an approximate value. What is the reasonable range in price that Berkshire Hathaway could pay and still be getting a good deal for its acquisition of Precision Castparts?